Hello, and welcome to another TMRN, Time Monk Radio Network production. I'm McLaren, and today is Friday, the 28th of October, 2011. Joining us today is the man in the big yellow hat, Blythe, Bane, or Whipping Boy, depending upon the direction of the precious metals, Turd Ferguson. Turd is an independent trader and the administrator and owner of tfmetalsreport.com. At his website, he frequently provides commentary about trading and investing in gold and silver. It's a community-oriented website with a number of features enabling Turdites to discuss and interact in forums and live chat. The contents of the website stretch far beyond just precious metals and is intended to help readers prepare for the end of the great Keynesian experiment. So please go visit, look around, and consider becoming a Turdite if you aren't one already. Hello, Turd, and welcome back to the Time Monk Radio Roundtable.
Well, thank you very much. It is my pleasure, and that was a fantastic introduction.
Well, I'm glad you liked it. The WebBot Forum administrator is Fox, and today he'll be doing the recording and technical support of the show. Several members from the forum were kind enough to join us for this discussion. They include members Romans 828 is True, also known as Romans, RTG, Skyhenge, and forum administrator Dr. Steve 1959, also known as Dr. Steve. For listeners to this interview, we're assuming you have a fairly good understanding of Turd's work and the premises that underlie his thinking. Again, the website is tfmetalsreport.com. This interview will be available on YouTube for free at the Time Monk Radio channel and at the website webbotforum.com. Are you ready to begin, Turd?
Let's get rolling. I've been waiting all day.
Okay. The first question from our roundtable will be on the topic of the people and monetary change. And for this one, we'll hand it over to Skyhenge. Skyhenge?
Okay, thanks. What effect do we, combined as buyers of smaller amounts of physical silver, have on the market, if any? And what effect did the Silver Liberation Army, started by Max Kaiser and others, the so-called crash JP Morgan buy silver campaign, at approximately the time projected for the tipping point Cliff predicted last November, have on the price of movement since then?
That's an interesting question, Skyhenge.
Thank you.
Gosh, to put that in macro terms, I mean, we're talking about, it's almost, I guess the first thing that comes to mind is voting. You know, when you vote, does your one vote make a difference? No, I mean, unless you're in Florida, maybe. But in the grand scheme of things, whether or not you vote doesn't really matter. I mean, whether or not you call up and order a sleeve of Eagles and take delivery, or whether you bought some of the silver Kaisers, it doesn't really matter. But collectively, you get enough people to do it, and it does. I'm not sure that the Silver Liberation Army movement, if you will, had a big impact in terms of physical supply and price, but it did have an impact in terms of public relations. And it was kind of catchy, and it became an internet phenomenon, and it turned on a lot of people to the idea that many of us have discussed for years, and that is silver market manipulation and price suppression. So from a public relations standpoint, it was a tremendous success. From whether it had an impact in depleting physical stocks, I don't know the numbers, but I would doubt it. Getting into the second part of your question about the tipping point and the timing of things and how price has moved. Silver has moved up. Really, you could go back and look. That it really took off in August of 2010. It was about $18, and all of a sudden one day it was 19, and a couple days later it was 20, and it was off to the races, and culminating in April of this year at $48 or $49. Yeah, could you look back upon other events and maybe as the driving force behind that move? Yes, but probably with the benefit of hindsight, the most significant event that caused silver to break out was not the Silver Kaiser campaign or public awareness, it was probably the passage of the Dodd-Frank legislation in July of 2010. Because in that legislation was this mandate of position limits in commodities, which finally those limits are being implemented, hopefully very soon. That getting passed in July was probably the fundamental thing that caused silver then to really get rolling in August of 2010. How's that? See, you guys remember this from last time? You asked me a simple question, you get a 5-minute answer. Sorry.
Well, that was a great answer, and so I would say then probably the biggest effect of the crash JP Morgan buy silver was that more people became aware and some more small buyers came into the market.
Right. I anything like that is helpful. The stuff that I talk about, or the stuff that Ted Butler writes about, or the great little videos that the silver people put together of the two little animated bears or whatever they were
silver
talking.
Bears. I love the silver bears.
All that stuff. There is no question in my mind, and frankly, anyone that is an observer of the silver market for any amount of time, there's no question. It's in the data. It's in the day-to-day movements that you can clearly see the manipulation and the suppression. So any education, or as I mentioned before, public relations, that draws more attention to this, the more light that gets shown upon it, you eventually can affect change. We wouldn't have the position limits. We wouldn't have had the vote by the CFTC 10 days ago if it weren't for the work of GATA, the Gold Antitrust Action Committee, who got Andrew, and make sure I get my guys right, Andrew McGuire, to testify about the whole entire scheme and how it works. That piqued the interest of Bart Chilton, who worked with Gary Gensler, the new chairman of the CFTC, and this all came together. Without that fundamental, the groundwork being laid by GATA and everybody drawing attention to this, then change would never be affected. So anyway, kind of bringing all that back together, it was the Silver Kaiser, Silver Liberation Army. Has that been successful? I have no idea how many they sold. I've got 3 of them that I bought just for fun. But in terms of awareness, they've been great. What we ought to think about is a silver turd. Now that, there's any people that work a foundry out there someplace, contact me at TF Metals Report. We'll get some. As long as we can put some big markups in them, that would even be better. So anyway.
Just think of the different denominations you could have.
Exactly. You could have, we don't want to go there. I'm sorry.
No, not right.
This is a family program.
Thank you, Turd.
Sure.
Thank you for getting things started in a very enjoyable way, Michelle. Really appreciate that. For our next question, we'll turn to Romans. Romans?
Turd Man, this is Romans. It's a pleasure to speak with you.
Oh gosh, Romans, if you only knew, you wouldn't say that. But thank you anyway. It's very kind of you.
You're quite welcome. I have a hypothetical for you. Hypothetically, let's say that the entire global economic system locks up. Banks close on temporary but indeterminate holiday and commence as we know it, commerce as we know it comes to a grinding halt. And let's also assume that out of the ashes, the resulting chaos, a new plan for a new world order currency system arises. How could you envision such a system? And even assuming it is precious metals backed, how could you envision it being implemented?
Well, you guys have some good long questions. That's an excellent question, Romans. And what's so challenging about that is it's tempting to give a specific answer to a question that is so full of hypotheticals that it's almost impossible to say with certainty well, this will happen, and then this would happen, and then of course this would happen, because there, A does not, A affects B, which affects C, which affects D, and it's impossible to really lay out a concrete answer. What I could say though, it would not even necessarily have to take some global credit lockup to cause that. Wars and insurrection, CME, coronal mass ejections, anything could cause something that would close banks and force a bank holiday, that type of thing. But to your question, if it were caused by a currency collapse, we got awful close to that. There was a time in 2008 when, in the fall, where it almost happened. I remember being on a flight from I don't know where I was going, Atlanta, someplace, and looking down at the landscape out the window at night, thinking how all these people I was flying over had no idea that they might wake up tomorrow and their bank would be closed, and then because we were really that close. So it's not out of the realm of possibility that what you described could happen. I think eventually, and again, with history as your guide, eventually the fiat money system will prove once again, as it has throughout history, to be unsustainable. And the pendulum will then swing the other way, back to a more sound money system. I'm not sure we can be a totally asset-backed monetary system. I'm not sure if we could go that direction, but what I would envision is a world of maybe regional currencies that are at least partially asset-backed, so that any individual that chooses to protect their wealth and their purchasing power by converting the fiat money into hard assets today, my hope is that after this reset takes place, that then you're able to walk into whatever your local exchange is and convert, should you choose, your metal back into whatever the new currency is. That would be the orderly way that I would hope things would evolve. There's a specific answer to that's one hope, that it would work out. That's what I don't want to say banking on. That's what I'm hoping for, that it would be something that orderly when this all comes about. Because in the end, as you mentioned, if the entire global system locks up, what's going to come out the other side? It's impossible to say.
Right, I agree with you. I kind of have a similar question that kind of dovetails with that from one of our forum members, Acorn Sales. They say there's been a lot of articles on King World News from Stephen Lieb and other writers on the speculation of the world's money supply tied to $10,000 gold. And they say, I guess some of this leads back to the New World Order conspiracy theory with a global currency spin from Lindsey Williams, etc. If the powers that be were to head in this direction and peg a global currency to gold, how would you see it playing out? And then they've got two options here. Option one being a massive bank holiday, or option two, a 1933 style confiscation attempt. And how would you prepare for it accordingly with your physical metals?
Well, this is kind of a similar question. I would let's work backwards from what you said at the end. You would prepare for this eventuality, and it really is a likelihood, an eventuality, by protecting your wealth with gold and protecting your purchasing power and your ability to buy everyday items with silver. You mentioned confiscation attempts. Look, there's a whole bunch of opinion out there about whether that could happen, will happen, and I'm not one to try to say one way or the other whether it would. I think from a practical nature, I think it would be almost impossible to enforce confiscation. And maybe that's impractical for me to say that, because maybe the government mandates it and puts out a law that anybody tries to barter with silver or gold, or tries to exchange gold or silver for other material goods, needs to be turned into the monetary police. I mean, who knows what kind of Orwellian state we'll end up in. But in the age of the internet and of instant global communication, I think it is highly unlikely that an order, a law can come down from on high that says, you need to turn in all your gold or you're going to be subject to prosecution. In 1933, they could go from town to town and just collect gold because nobody would know they were coming. As soon as that was even discussed or mentioned in today's world, the uproar and the outcry would be such that I just don't think it's practical. But again, I mean, that's just me. Maybe it will happen. In terms of a bank holiday, with this currency reset, yeah, maybe. Yeah, you could see. I mean, I could certainly see that, where all of a sudden the U.S. is no longer the reserve currency, and so the world breaks up into regional currencies, kind of like the euro. Kind of a Southeast Asian currency, and then there's been all this talk that has been brushed off as conspiracy for years about an Amero, some combined Canadian, Mexican, U.S. North American currency. I certainly see it happen where the dollar just becomes a part of a regional currency. And it'd be simple to do. I mean, you just close the banks. Hell, maybe we wouldn't even have to close the bank for a day. All of a sudden, whatever you have is, your bank statement one day is denominated in dollars, and the next day it's a different number denominated in Amero or whatever it is. So I think it'd be just as simple as that, all done digitally. All the way back at the beginning, you mentioned something about $10,000 gold. Every time I've seen that number, it's a relation, a ratio, a relationship between the amount of ounces of gold that the United States supposedly owns, allegedly owns, and the amount of U.S. debt which is currently $15.2 trillion or something like that. And if you take the amount of ounces of gold that we allegedly have and you divide it into the $15.2 trillion, then you get 10,000 or probably more dollars an ounce of gold. That's a number I've always seen. Okay, it makes sense, but I don't think that's any kind of hard and fast formula as for what gold should ultimately trade at.
Yeah, I agree. I think Mike Maloney has done some work like you're talking about there.
That guy done a lot of work and deserves a lot of credit for leading the fight for as long as he has.
Right. Do you have any faith that the general population is awake enough to demand and ensure that a fair and equitable system would evolve?
No. How's that for an answer?
That's honest.
I mean, that's what the site is about. I mean, to give a shameless plug to TF Metals Report.
Go for
it. What I recognize after I started this blog and people actually showed up, which was astonishing to begin with. What I came to quickly figure out is there's not a wealth of unfiltered, objective information about metals and mining stocks and how to invest and protect yourself. There's a lot of biased, non-knowledgeable opinion out there that is not objective and can lead you astray. And I thought, gosh, if we could create something of like a wiki where all of the members of the site that can contribute what they know, and then the individual reader that shows up who's on his or her computer late at night because they know something's wrong and they know they get just stick it in the money market or continuing with their stockbroker's plan of buying mutual funds just isn't getting them anywhere. And so they're banging around their computer trying to find some other source of information. They stumble across a site, and they will find a wealth of information provided by people that are in the same boat as them. And having been in financial services for 20 years, I just know how that other side of that game works. If you started having the itch to that you wanted to diversify into gold or silver, and you're sitting across a desk from your Morgan Stanley or your Merrill Lynch stockbroker, and you say, I really think we ought to get into some gold stocks. First, that stockbroker is going to, roll his eyes at you like you're some kind of nut. Then they might patronize you by saying, oh, okay, well, I'll look through my Tredenza here and pull out a research report on Newmont Mining or some such company that maybe his company, his brokerage firm, has an investment banking relationship with, and thus has a buy rating on, and then they'll say, here, well, read this. And then, maybe he'll patronize you by letting you buy a couple hundred shares. That's mainly how people get their information for investing in metals. And so at the site, we try to, like I said, try to educate people and do it in a very objective way. So do I have faith that the general populace is awake enough? No, I don't. I mean, the education system in this country is a disaster. And if you ask people basic questions about economics, they don't know. And frankly, that's okay. I mean, life's tough. I mean, the cost of living has soared over the last 30 years. At the same time, taxes have doubled and tripled, and people have to work two jobs, and both mom and dad have to work just and try to put the kids in daycare and school and all this jazz. I mean, nobody has time. I mean, who has time to sit around and educate themselves to be there to demand, as you said, a fair and an equitable system when you're worried about just making your mortgage and how the hell are you going to put your kids to college and your parents, oh my God, dad looks like he's getting Alzheimer's, and oh crap, how are we going to put him in a nurse? I mean, you got all this other crap you're worried about. You don't have time to worry about who the hell this guy Keynes was and how he screwed up everything. Well, not he didn't, but all the politicians did. So anyway, do I have faith? No. And that's probably my primary concern is then power then goes to the noisiest, the people that do at least know, at least ahead of time, the change is coming. And then they make the most noise. I mean, gosh, not to sound really diabolical and goofy, but when Hitler was originally elected chancellor in 1932, it was just worth a simple plurality. I mean, it wasn't like there were 95% of the people voted for him. But you get in and you consolidate power, and then it's off to the races. And with the type of changes that are coming, and with the amount of uneducated and asleep people that are out there, who knows what kind of leader and what kind of system we're going to get. It's definitely something I'm worried about.
Yeah, I hear you. Me too. I can relate to your Merrill Lynch story. I used to be, back in the day, I was a Merrill Lynch broker, and that's what they did was hand you a report to peddle stock.
Yep.
And also driving traffic to sites like yours is, I think, something all of us can do. So anyway, I appreciate the answers, and I'm going to swing it back over to McLaren.
Oh, hold on, can I ask questions from time to time?
Sure.
Is that legal? Acorn sales. I just think that's such a great name. Is there anything behind that?
That's a question I can't answer. I don't know the answer to that, but I agree with you. That is an interesting name.
Okay.
Thanks, Romans. And Turd, if you swing over by the WebBot forum, you can find acorn sales there right next to pecan sales and walnut sales.
Oh, sweet.
And you can ask him specifically what it was that got that name going for him. I'm going to bring it back over onto the topic of metals because that's what we're here for today, not nut sales. Turd, returning to the topic of silver. as a monetary metal globally, realistically, silver's role came to an end in 1964. Beyond silver bugs, it's now mostly thought of or treated as an industrial metal. In Europe, there's roughly a 10% value added tax on purchases that is not applied to gold, and which is in addition to any coinage or dealer markup premium. Barring a financial or economic collapse that would also destroy the industrial component of the demand equation, how and why would silver ever regain its monetary status compared to gold?
Well, if anything, well, there's a couple different components to answer that question. One, and it's where I was going to begin with. One, it's a denominational thing. Gold is $1,743 an ounce, so it does not make it, in terms of everyday commerce, it does not make it a feasible bit of of metal to carry around in your pocket. It's fun, it's pretty cool. Hey, look at this, but it's not the type of thing you want to leave laying around or let fall between the cushions of the sofa. So you need something that's denominated in a smaller number, and silver, as recognized as a precious metal and as money for thousands of years, fits that role. You mentioned 1964. There's some really interesting work being done in Mexico currently by a man by the name of Hugo Salinas Price. And I wasn't familiar with any of this, and I got to know a guy across the pond, as they say, by the name of Ned Naylor Leyland, who is a financial, I guess we'll call him a money manager over there. But he's really made himself, and deservedly so, into one of the preeminent bugs. I love that term. Preeminent silver bugs, gold bugs in the world, and is doing a wonderful job spreading the word. And Ned put on a conference. He hosted it. His firm put it on back in January, so 10 months ago. He had this great list of speakers. If you go to their website, his company is Cheviot Asset Management, which is CHEVIOT. If you Google Cheviot Asset Management, it'll take you to the site because it's like a .uk or something like that. On that home page, there's a link to what was called the Sound Money Conference. And when you go into the Sound Money Conference, you can watch videos of all these different presenters that were there. Well, one of the presenters that day was this Hugo Salinas Price. And Hugo is I guess you call him retired. I mean, I don't mean to make it sound like he's just this old dude, but he's an older gentleman, and he's a retired, very wealthy man in Mexico, and he's made it kind of his deal to promote silver as, I want to say, an alternative, as a supplemental currency within Mexico. And the key, as I understand it, to his plan is to make a silver coin that does not have a set denomination, and that if you own a Canadian maple leaf, for example, a lot of folks have sleeves of those. They're very pretty, by the way, but on there it says $5. Okay, I don't know what, frankly, I don't even care if you can use that to buy something for $5 Canadian. I suppose you probably can, but that's a lousy deal, because that thing's worth 35 American. So who's going to take that thing and buy, a magazine in Canada? Doesn't work that way. So it's held instead as an investment or a collector's item, because the silver itself is worth more. So what Hugo Salinas Price is doing is he's promoting this plan that will make the coin, you still be a silver coin, but it will have a variable denomination, if that's the right word, where one day it'll be worth $35, but the next day, or if it's revalued weekly or something, might be worth 36. And the beauty of that is it would give the average everyday Mexican an inflation hedge. The value of their money could not be devalued. How's that? So it's a fantastic way to do it. So anyway, that's the first thing that came to mind when you asked me that question. I would encourage anybody listening to go to that Cheviot site, look up the Sound Money Conference, and watch Hugo's presentation and get all the details. But I'm not saying it's the way to do it, but it's certainly a feasible way that silver could become money again.
Okay, thanks. I know you're familiar with FOFOA, FOFOA's website, and they got into it quite a bit with regard to bimetallism and gold or silver.
Yeah.
Consequently, it's something that could create problems in that you've got two different metals, each with their own supply and demand characteristics, and hypothetically, a central banking or exchange facility would need to have an infinite supply of gold or silver available to buy or sell and make market in order to establish the pricing that would then underlie a bimetal marketplace.
Well, and that's all part of the problem. Yeah, that's what makes. I mean, that was why Nixon closed the gold window. And that would make this idea of going back to a gold standard, that's what makes it so, I don't want to say impractical, but it makes it really hard to do.
Yeah, the other thing is we do have decimal places, and as long as you can take your fiat script in and exchange it for units of metal, they can shave it down to a very, very fine little piece. It doesn't have to be even something, you get a BB, and it's maybe 1/50th of an ounce.
Yeah,
something like that, a flat
yeah,
BB.
or even if it was just a digital credit that you knew was allocated to you.
Yeah.
The thing that eventually will stop is just this unlimited ability to just create money from nothing, from whole cloth. That you have to have, a quarter of an ounce of gold for every $1,000 that you wish to create or something. I mean, this is a far bigger problem and for more people that are far smarter than I to solve. But it will come back to something like that to rein in this destructive power that governments have to confiscate your wealth through the destruction of your purchasing power.
And we'll come and talk about that in a little bit when we come back to another question of mine, which I know you're going to love, Turd. But in the meantime, we need to roll over into charts and technical readings on precious metals. Yeah, your topic area. And the first person to hit you up with an impossible to answer question is our good friend RTG.
Well, hello, Turd.
There he is. Hi, RTG.
Yes. Hi. Yeah. After reading your postings, this is such a pleasure for me to finally talk with you.
I appreciate it. Thank you.
Thanks. Sure. Okay. Turd, it's often said that the real professional silver traders trade silver by following the gold-silver ratio. How much weighting does the gold-silver ratio receive in the Turd's silver market calculations? And are you currently getting any market signals?
Well, this will only add to my reputation as being a non-professional silver trader. I can tell you that because I don't look at that at all.
Okay.
The metals markets. Let me back up. There's historic ratios of the value to gold of gold to silver and vice versa hold some water. In the current way that the world has decided to allow metals to be priced, it doesn't matter what the ratio is because gold is and silver are priced off of the COMEX and the LBMA in the futures markets using paper metal, which is undoubtedly leveraged 50 or 100 to 1 versus the actual physical metal that's there. Prices are manipulated and suppressed on an almost daily basis. And so this whole idea that silver is this and so therefore gold should be that based on what today's prices are, that is just nonsense. It just doesn't have anything to do with anything. Now,
Okay.
eventually, once we're allowed to actually have some type of true and fair price discovery, okay, then fine. Then things might revert to some historical number, but I don't use that as any calculation where I think things are going tomorrow. What was the second part of your question? Are there
Okay.
anything I'm
Have you
looking at?
currently gotten any do you have any current market signals? But you don't really follow it that closely.
Well,
So.
I look at some of the more fundamental stuff. I finally couldn't take it anymore. I'm very fortunate that I made what turned out to be a rather prescient post on Monday night. But I was itching and had been itching for a couple of weeks to get excited and to throw a little raw meat to all the turdites, as we call them, and give them something to be excited about. And I put something out a couple of weeks ago, and everything kind of still kept going sideways. And I kept watching things, and finally what pushed me over the edge last weekend was something that we call the Commitment of Traders Report. That is data that is compiled on a weekly basis it's a summary of long and short positions of speculators, small and large, meaning like banks and hedge funds and people like that. And the banks would fit into like a commercial category. And this summary comes out every week that just shows you the movements of the week prior of who's adding to positions and who's lessening positions. And it's not a be-all, end-all report, but by paying attention to it every week, you can begin to definitely notice some trends. And then the key to that is then knowing what the heck all that information means, what that trend means. And what finally pushed me over the edge last week is you could clearly see in gold. I mean, plain as the nose, if you've been doing this stuff, plain as the nose in your face, that the speculators were out really in almost a record low of speculative longs, as we call it. Well, okay. You think, okay, well then that's a two-edged sword. There's a lot of people that are willing to buy back in once it gets going, so that's good. And on the prevention of having to go down further, well then who's going to sell? If there's not any longs left, especially after you're already down $200, if you haven't sold yet, you're probably not going to sell. So you don't have a lot of selling pressure. You don't have a lot of potential people to sell if things really get going south. So it's like, well, it's not going to go down much further, so it's not going to take much to get it going up. And then when you could look at the bank side of that Commitment of Traders report and see that banks were beginning to cover their long-held short positions, well, then you knew that kind of then gave you that old adage, that the smart money versus the dumb money. And hey, I'm a speculator, so I'm not calling speculators dumb money and being mean about it. But speculators are usually the dumb money. I mean, they buy high and they sell low. So the speculators are out or getting out or are done and not long. And the banks, who would be the smart money, the ones that actually control the markets, are the ones that are doing the buying. Well, that's not real hard to see where maybe this is a market that's going to go up. And so we've been kind of range bound between roughly 1,600 and 1,700 for 3 or 4 weeks. The chart started to look a little better, and then with that Commitment of Traders report, I looked at Mrs. Ferguson on Monday, and I said, I got to go down into my office and write something. I was down there for about 2 hours and banged out something Monday that said, I think I said a 10% rally by the end of November. Well, heck, we've already seen at least a third of that happen, maybe half. Thinking maybe we get 1810 or 1820 sometime by Thanksgiving or so. Well, we're about halfway home, yeah. So I'm fortunate that I got that on the record because if it would have gold would have been taken off and I was just sitting there twiddling my thumbs, I'd have felt kind of silly. But anyway, I can tell you this whole story, just if anything, just because not the gold silver ratio, that doesn't mean anything to me. The underlying fundamental things like that Commitment Traders report is something you can look at every week and use it for some fundamental analysis.
Okay, then I take it you don't follow copper and its relationship to silver very much?
You have to. It's not something that, copper did this, so therefore silver is going to do that. I mean, I don't use it as like some predictor, but you have to follow copper. If you're going to trade commodities, or even equities, you have to follow copper. I just don't think you can't use it as a primary, like this is one of three things that definitely affect silver. If copper's going up, then silver, because silver is more and more becoming money, not just a commodity. It's more money like gold. But copper does tell you a lot of things. And I was visiting with a guy by the name of Jim Comiskey last week, who's a longtime commodity trader, and he said, he was talking about how copper historically leads the equity market, that you can look at copper just because it's such a base industrial metal that if copper price is rising, then there's demand for copper. If there's demand for copper, then people are building things, homes and buildings and cars and everything else. And since silver is still, as the question came up earlier, still thought of as an industrial metal, then you got to be following. It's at least got to be part of what you're thinking about when you're projecting where silver is going. And copper is going like crazy and has been for 5 or 6 trading days now. So that does bode good things to come, at least in the short term.
Mm-hmm. Okay. Well, Todd, what I've noticed from your technical chart work, it seems you place a good deal of emphasis on trend and channel lines,
mm-hmm.
as well as horizontal support levels.
Mm-hmm.
Okay. Do you ever use any directional or momentum indicators, such as exponential moving averages, percent R, relative strength, rate of change, MACD, or stochastics?
I'm sorry, I'm just sitting here kind of chuckling because no.
Yeah.
I love all this stuff. And technical analysis, the smaller, more closed market that you can deal with, the more valuable technical analysis is, because it's, at the end of the day, it's kind of a self-fulfilling prophecy. If everybody's looking at the same chart, and if everybody says, gosh, it's going to have some resistance at 25, and if everybody and their brother thinks there's going to be resistance at 25, then people are going to start selling at 24.50. And lo and behold, it never makes it to 25, and a week later, everybody goes, see, look, there was resistance at 20. Well, no kidding, really? So there is something to it. So all this other stuff, though it does have value, and frankly, the only time I ever look at it is if it shows up on a chart, and you can look back historically and go, oh, look, when this squiggly line got all the way up to the top, that corresponded with a low. Oh, and that squiggly line is near the top again. That's about as detailed as I get with that stuff. I draw those channels and those lines, and this, because everybody's looking at that same stuff. It's the same thing that I mentioned earlier about why it works in the first place. See, there's been not a lot, but there's been some talk recently on the site about the value of technical analysis in manipulated markets. And why it's a lot. Sometimes it's people that show up just to say bad things about me, which I get a kick out of anyway. But they'll say, well, why would anybody listen to this guy anyway? Because of that value of technical analysis in a manipulated market. Well, what I'd be the first to admit, and this is one of the first posts I ever made, the reason my technical analysis works is precisely because they are manipulated markets. Mm-hmm. Because if you're JP Morgan and you have this concentrated short position in silver, and it is your job to try to suppress the price of silver to your advantage and to the Fed's advantage or to whoever's advantage that you're doing, then what you want to be able to do is at the right time and the right moment set off a cascading sell where you drop some shorts on the market, it triggers some stops, you start getting longs to liquidate, it starts generating margin calls, maybe the CME jumps in and raises margins and makes things worse, okay? But you got to know, you have to do technical analysis to know where is that spot on the chart that has the highest likelihood to have the biggest impact, okay? Mm-hmm. So if you can then think like JP Morgan, if you can think like our friend, the Wicked Witch, then you can begin to anticipate where this is all going to happen. And that's all I like I said, I made it clear from day one, that's all I do. And the only reason that I now have this reputation as being this, witch, soothsayer, is because I have 100% faith, not in technical analysis, but in the fact that gold and silver are manipulated. And so once you accept that, then you can begin to look and say, okay, if I were in charge of executing these trades, where would I put that? And then you can quickly figure out where the price might turn and head higher or where the price might stop and head lower. It's no more complicated than that.
Okay, Turd. All right, this will be.
Go ahead. I'm sorry.
I was going to say this will be my last question for you then. How much importance do you place on the weekly and monthly charts as opposed to the daily or 4-hour charts?
Same thing. Same thing. If I'm looking, it just depends on the time horizon of what I'm looking for. If I'm looking for a short-term turn, then I'm going to look at the shorter-term charts. But the long-term charts are exactly the same tool. You could pull up a weekly chart of gold and go back and look and notice that gold's been in the same rising channel ever since the introduction of quantitative easing in March of 2009. And if you think, well, if that's not going to change, and of course some people would try to argue it is, but I think that's silly. If you think that's not going to change, then why would gold get out of that channel? Now it got ahead of itself in August, and that was almost entirely due to short covering on the part of the big banks. And it has since then, once that worked its way out, they managed the price back down. Now it's back in the channel. And it just trades towards the top of the channel, and then maybe 6 months later, it trades back down and touches the bottom. But all the while, it's just trending higher and higher, and it's because of the fundamental part beneath it. So I look at those longer-term charts to be wary of, or to be aware of the longer-term trends. Just one last thing, though. A lot of times, people assume that, there's some kind of crazy logic or rationale behind one day I'm showing a 15-minute chart or an hourly chart or a 4-hour chart or a 3-hour chart or whatever. Truth be told, I'm showing the chart that gives you the picture that complements what I'm trying to say. To get the proper length of time on my chart, maybe it needs to be 3 hours. And it's not that, because the 3-hour chart never lies. It's nothing like that. It's just simply it fits from a time scale standpoint into what I'm trying to show the reader, as to where I think price is going.
Right. Okay. Well, I get it, Todd. Yeah, I really appreciate it. Thank you very much.
Just for you slurred an R a couple of times, and I don't want anybody to think if someone paying close attention would say, they just spilled the beans. Turd's real name is Todd.
Turd, sorry.
It's not. My name is not Todd. My niece's husband's name is Todd. How's that? If anybody wants to hey, there you go. But my name is not Todd. It's Percival Sweetwater. I'm sorry?
Can we put an A in there and call it Toad instead?
Toad, yeah.
Toad.
My mother-in-law has a friend who's maybe listening to this, she's Armenian by birth. And so, though she's been in America forever, and she heard that I was going by Turd, and she had no idea what that meant. So then she Googled the word Turd and found out what it was slang for. She always just thought that was horrible. So she wants to call me Tord for something, because she just can't get herself. She's just this nice older lady now I'm really in trouble, because she's going to hear that I just called her a nice older lady on the internet.
Well, I think we can fix that. We're speaking with Turd Ferguson. Turd Ferguson. Please help support him by visiting his website, tfmetalsreport.com, where you can become a Tordite and help prepare yourself for the end of the great Keynesian experiment. We're going to roll on to our next topic area, which is the future, as if we haven't been talking about it, the future and precious metals. Our first question will actually come from another forum member. We're back to Acorn Sales, but it'll be asked and posed to you by RTG. RTG?
Yes, Turd, on behalf of Acorn Sales. She's referring to Jeffrey Christensen's presentation at the Silver Summit.
We have to.
Yeah. Well, she's curious because he originally committed the faux pas, so to speak, by admitting that the leverage, the leverage on LBM, the futures trading, was 100 to 1, And now he up at the Silver Summit, he raised it to 400 to 1, but said it doesn't matter. And then he said
that's a Keynesian argument right there. I'm sorry, I didn't mean to interrupt you.
Yeah, no, please go ahead. I'm sorry.
Guy. I just can't stand him. But please go ahead.
All right, well then, okay, so you just consider it a Keynesian argument that 100 to 1, 400 to 1.
1,000 to 1. Who cares? It doesn't matter.
Rock
if you want to
on.
take delivery, you can take delivery. Who cares how much? Okay, Jeff, whatever.
Okay, then Christensen claimed that that May 1st drive-by, the beginning of May, that drive-by shooting, he says that was caused by a change of trading positions on the COMEX, which it was, of course. Under U.S. commodity law, it is illegal for prices to be set on the COMEX. The futures and options contracts can only be a price discovery mechanism and not a price setting mechanism. Price discovery mechanism and not a price setting mechanism.
Right.
So if paper is oversold, here's the question then. So if paper is oversold either 100 to 1 or 400 to 1, whatever, once the paper fraud is exposed and turns to confetti, how would you expect the physical price discovery to play out?
Well, that's the big question. For a long question like that, as you might imagine, I got a long answer. So everybody buckle in. I'll try to keep this brief. Where do you start? Gosh, one, on the paper explosion, paper turning to confetti. They're going to fight that. They being the empire, the cartel, the too big to fail banks. If they're going to do everything they can to keep that from happening, and so you got to continue to expect manipulation. Now, what's going on with the CFTC and whether they will be able to implement position limits, it's not as important in gold as it is in silver, because silver is such a much smaller market compared to gold. But nonetheless, if we do get position limits actually enacted, then that will change the ability and definitely affect the ability of the big shorts to continue to suppress price. But that doesn't mean that all of a sudden the COMEX will be a true and fair price discovery mechanism, because that's really we've allowed it to be that, but that's not what it's for. That's not what it was intended to be. Now, personally, I'm excited, and I've been talking about this on the site now for months, about what is called the Pan-Asia Gold Exchange that is going to be opening in Southeast China, hopefully within the next 6 to 8 weeks. I was in communication with the gentleman who is essentially in charge of making it happen. He's based out of Hong Kong, and I'd gotten kind of connected with him through the intervention of a turdite, and they're working diligently to get all the infrastructure laid to make this new exchange happen, which is, as you might imagine, a pretty complicated procedure to put an exchange online. But they're going to get there, and in the end, what that will be is a fully one-to-one backed gold exchange that will trade a spot contract or a contract based on the spot price. What we hope that will accomplish is that you'll have gold, an actual spot priced contract in gold that trades in China, that will have its own price fix every day. And then you'll be able to compare that to this paper gold contract that gets a price fix in London twice a day and a price fix in New York once a day. And if there's this major discrepancy between the physical price and the paper price, that discrepancy will be closed naturally by arbitrage. And that will eventually serve to change that dynamic, because, and this is a line of Ned Naylor Leyland's, what you have now is you have his analogy or his metaphor is the tail wagging the dog, in that the bigger part of the puzzle is the spot, is the actual physical price of gold. That's the dog. The tail is the futures market, and it's the wiggles of the futures market that affect the spot price. And that's not how it should work. It's the actual value of that spot metal and what you can get for. I mean, that is your price discovery. It's not what the monkeys decide is today's price on the COMEX. So if we can have a true physical metal exchange and say, and here's and for the people that don't, arbitrage is this kind of money management term that a lot of people don't know what that means. What I mean by that is, say the value of gold on the spot exchange in Kunming City is $2,000 an ounce, but the price that you're getting that it's trading at in London is $1,800 an ounce. Then the arbitrage is the meeting of those two prices, and that you can buy gold and take delivery of it at $1,800 an ounce in London. And then you can march that gold over to China and sell it at $2,000 an ounce. And by buying in one place and selling in another, those two prices eventually merge. Maybe, for simplicity's sake, at 1900. Now, there's also this physical movement that may serve to bankrupt those exchanges, because you're taking that physical that's in the inventory in London or in New York, and you're taking delivery of it, and you're putting it on a boat and taking it over to China and selling it there at this higher price. Now, you can imagine why the Chinese are doing that, and that kind of would get back to the currency questions we were talking about earlier as to why the Chinese are looking to accumulate gold. But that may have that. I'm very optimistic that is going to have a significant, substantial impact on this whole price discovery madness that we've found ourselves in, because there's no other way to do it at this point. So hopefully that will change things as we get going. I spoke for so long, I don't even remember what the hell the question was.
Oh.
So did I answer?
Okay. We were talking. Yeah. Oh, you sure did.
Okay.
Once again, thank you so much for your words of wisdom. And now I'd like to move forward to Mr. McLaren.
Okay, Turd. We're going to get into something a little bit heavier here. You closed your October 17th blog posting with this comment, quote, "Again, please spend some time considering both sides of the Keynesian argument. Just because I say, quote, the end is upon us, end quote, doesn't make it so. I could, gasp, be wrong.
That could.
You must research and consider the facts yourself. Come to your own conclusions, act and prepare accordingly," end quote. While your website focuses on the end of the great Keynesian experiment, I'd like to get your perspective on a potentially new monetarist experiment based on Milton Friedman's quantity theory of money. In the area of the blogosphere and from various monetary reformers, there is the so-called modern monetary theory, MMT, that's being proposed. Awareness of this concept is being raised by journalist, author, and filmmaker Bill Still in his film The Secret of Oz. And the bloggers range from Edward Harrison of Credit Write-Downs to Australian economist Billy Mitchell writing at his Billy blog, and Colin Roach over at Pragmatic Capitalism. They're doing educational work in this area and are promoting the concept. Also, noted academics Michael Hudson and William K. Black and the writers at New Economic Perspectives are doing a sequential series on it. Have you dug into this at all, and what are your thoughts, if any?
Good heavens. That is a question. Yes. First of all, I would just want to reemphasize what I said on that blog posting a couple of weeks ago. Educate yourself. I think I know what I think I know, but that's only because I took time to educate myself about what was going on around me. And so I encourage everybody to use TF Metals Report as one of hopefully many sources as they try to figure out what's going on in the world. Modern monetary theory I don't know a lot about it, but from what I do know, that's kind of a Keynesian theory in itself, isn't it? Kind of. In that, I mean, I'm asking that question back. I mean,
Yes and no.
The idea behind it is that the government is this kind of this self-contained little thing, big thing, that can print money and fund its own debts almost to infinity.
Yeah, that's kind of the essence of it. It's that as a sovereign entity, the government or of the United States or any other nation for that matter doesn't need to borrow its money into existence. It can simply print it and spend it.
I'm sorry. I think that's bullshit. Excuse me. I think that's crap. That's nonsense.
Okay, we know what your thoughts on that are.
Yeah, that the Weimar Germany worked out great, following that same idea. The French in the late 18th century, they tried the same. It doesn't work. It assumes this little static, perfect little pie, a closed system, and we're anything but a closed. I mean, with the free flow of funds globally, to say that any government has that ability, even the U.S., as the global reserve currency, has that ability to fund itself, and that there are not negative impacts of that. It's just, I just think it's terribly short-sighted. I put that in the problem that we have, and I'm sorry, we get off on a tangent a little bit, but the problem that I see us having in general right now, particularly in the U.S., is that there's nobody around that has any kind of power, in charge, if you will, that has any other experience other than when the U.S. wasn't this hegemonic superpower. Nobody in a position of authority has any experience to 1932, because those people are all dead at this point. And so the only basis that anybody has for their rationale and their worldview is this U.S. hegemon, that's the world reserve currency post Bretton Woods. Well, that's not the way the world has always been, and that's not the way the world's going to continue to be. And so if you base your monetary theory upon the status quo just because that's the way it's always been, I mean, that's doomed to failure. It's Connolly, John Connolly was the Treasury Secretary. I think the same Connolly that was riding in the car with Kennedy. And he's quoted from whatever year it was, 1973 maybe, or I don't know if he was Treasury Secretary under Johnson or whether it was under Nixon. But his famous quote was, he was addressing some, creditor nation of ours. And he said, the dollar is our currency, but it's your problem. Because we export all of our inflation. So yes, in that world where you can export all your inflation, then fine. The unlimited fiat money printing to fund the government theoretically could work, I guess. Maybe not even that. But nonetheless, that is not where we are headed. And so therefore, I think that the idea that the government can just fund itself by just printing money or digitally creating money, and there are not these after effects, it's just nonsense. I mean, we have seen now the horribly detrimental impact on the middle class of 40 years of indiscriminate money printing, and the standard of living decrease that has come from that is, and we talked about it earlier. I mean, it's just horrible, and it's going to continue, and it's only going to get worse because as they create money from whole cloth, then there is more money chasing a static number of goods. And my bachelor's degree is in economics, and it may be from that great academic institution of the University of Nebraska and not Wharton, but I did learn that's a law of economics right there. You can put that on your chart of aggregate demand and supply. If you're going to increase the amount of money chasing a static amount, or God help us, a decreasing amount of goods, the price is going to go up. I'm really going to get off on a tangent for a second, but the Occupy Wall Street people talk about the 99% and all that kind of jazz. Okay, yeah, math, you get 99% versus 1, which I guess is kind of this class warfare thing, but they're not going to get anywhere talking about just the 99%, because the most of that 99% are the people we talked about earlier that are just working and trying to put their kids into college, and how are they going to pay for their daughter's wedding and their nursing home care for their mother and all that kind of jazz. They're not going to show up out of the blue and go march on Washington. I mean, it's just not going to happen. However, maybe a better percentage would be, we are the 22.6%, which is the current, if you use John Williams and his shadow stats, the current amount of the U6 unemployment, those that are underemployed or given up working, or, not just your 9.1 unemployment rate. 22.6% is the true number of unemployment, the people that have no job, have quit looking, or are working part-time just so they can get something, delivering pizzas. Now, if those 22.6%, when they show up, God, who knows what kind of revolution we're going to have. And that day, if we continue down this current path, is coming, because those people have been, you can say, well, I'm making enough money, the wealth effect that Bernanke talks about, because my house has gone up, or my 401k has gone up, so they're printing money, all these assets are going up, and I'm at least keeping up with inflation. Well, good for you, but what if you're part of the 22.6% and you don't have a job, and all of a sudden a gallon of milk is $6, and a loaf of bread is $5, and you're trying to feed your kids? Those are the people that are going to march into Washington, and that's when the Pandora's box is going to be opened. So anyway, this idea that, getting back to your question, I just think is just folly. It's nonsense that we live in this cute little academic fuzzy-headed world where, yes, well, theoretically, yes, we can just continue to print money. The government control it. I don't buy it. Sorry.
Let me throw a qualifier out at you.
Okay.
They only increase the money supply at the rate at which the population increases.
Right. Tell that to the politicians.
That's why you don't give the power to the politicians.
Right.
As Bill Still had suggested in his The Secret of Oz, you create a separate monetary authority. You send the Fed back to doing its job of just being a regulator. You take away the power from, say, the Office of the Comptroller of the Currency, make him then the comptroller of the currency instead of a super big bank regulator, and have that same entity become answerable and reportable to the people through an electoral mechanism.
On the other end of the wormhole, when we emerge,
Sure.
that would be fine, I suppose. And maybe that currency is backed partially by some hard assets too. If we can get through the coming insurrection, if you will, and have that type of apparatus and structure in place, well, okay. To begin with, though, to think that the politicians are going to cede that power back to, not going to happen.
Okay. All right. Well, so much for trying to get an intellectual answer out of a guy by the name of Turd.
Yeah.
Okay. Well, we're going to move on to our next question. It will be posed by Skyhenge.
All right. This is, pardon me if I've butchered your name here, from Perflidit on silver availability.
Okay.
Taking as a premise that we have never left the greatest recession and seem certain to enter a fiat-induced implosion into the greatest depression, discuss the future of available silver, noting that most of presently mined silver is a byproduct of mining for minerals that won't be in much demand during a severe depression.
Well, that's an interesting idea. I would wonder if the mining of specifically for silver will become a profitable enough venture that will pick up the slack. That that everything that comes, the nickel and the this and the that, the zinc or whatever it is that comes out with the silver will be like a byproduct that nobody wants because they're going to all this trouble just to get the silver because it's worth $200 an ounce. That's an interesting yin and yang, if you will, of whether silver could be depleted just because it's not being mined as heavily. But like the first thing that comes to mind is that the mining activity, silver specific, may increase because the price has gone up so far due to the shortages. I mean, that would be kind of a capitalistic way to look at it.
Yeah, I agree that I think that you're right about that, because obviously when silver gets valued a lot higher, they're going to be mining it specifically. And again, referring to the available silver topic, please discuss the topic of, say, for instance, jewelry suppliers encountering difficulty in securing silver for their customers. Is it plausible that Bix Weir of Road to Ruta is right and we're on the cusp of virtually unattainable significant quantities of silver bullion?
Yeah, maybe. The anecdotal evidence is out there everywhere. I mean, I get emails all the time from people pointing out, this mint is out of this, or this supplier no longer has this, and they're on back order for 3 weeks. And you get all this anecdotal evidence, and you think, I mean, after a while, maybe you really got something. Maybe you get enough of all that line, all those dots connect into something that is actually there. And I don't mean to say that I don't, because I think it is there. You can see it in the sales at the U.S. Mint after the latest price takedown in September. The amount of silver eagles being sold through the Mint were at record levels, and they are already had sold more. I think they were ready to pass in October the amount of total sales that they had in all of last year, and there are a number of reasons for that, but that idea that there's a shortage is very real, and people are utilizing the dips in price to buy rather than to sell, and that is a paradigm shift that does not it's not going to reflect favorably on the balance sheet of J.P. Morgan and the like, in that it's going to be increasingly more difficult for them to drive price. And so they maybe in the end, they're going to welcome getting out of the game with position limits and say, we don't want to jack with that anymore. And I'm going to go off on a tangent here, but that is what happened in gold back in August. That commitment of traders report that I was mentioning earlier, you can go back and look at it, and you can clearly see the move from Sunday night, the 7th of August, until September the 16th or whatever it was almost entirely on the backs of bank short covering. And you think, well, why that time period, and why did it break out and run from 1650 to 1920? Well, it was on the late afternoon of the Friday the 5th that the word finally hit the headlines that S&P was lowering the credit rating of the U.S. From a AAA down to AA plus. Gold opened about $20 or $25 higher that Sunday night on the Globex, and didn't look back for 6 weeks. It finally went back down and filled the gap on the chart here a couple of weeks ago, which amazingly everything always seems to want to do. But the banks, the big holders, the big shorts, clearly took that as a sign that they had to cover some of those short positions. I mean, that you never want to be short anything. Margins are always high if you're short. And it's always very nerve-wracking because when you're long, you can only go to zero. But theoretically, when you're short, your position could move to infinity. And so it's a much more challenging position to be short. And clearly, the decisions were made post that downgrade to cover short positions. Again, the evidence is there in the commitment of traders report. We've since now, earlier this week, there was a report out of by Bank of America, which is still in business, I guess, as we speak tonight, but we'll see. Anyway, a report out of Bank of America that they're expecting perhaps another downgrade, or other ratings agencies will go to AA plus by the end of this year, because this whole super committee nonsense will fail to politically get any traction. and the ratings agencies will be forced to cut. Well, if that's the general line of thought behind the banks, where they think the credit ratings are going, well, then you could rightly expect that maybe the banks start covering shorts again. Oh, and lo and behold, gosh, about the same time that report came out, gold then went up $100 this week. Oh, and lo and behold, we saw the open interest actually going down while that was happening. And open interest is the total amount of contracts outstanding. And if the amount of contracts outstanding is going down while price is going up, that is a sure sign that positions are being closed. Well, that's why open interest is going down, because positions are being closed. Well, what side of the trade is being closed if it's going up? Well, you're buying and closing short positions. Does that make sense? If anybody wants me to go back over that, I'll be happy to, because I kind of just breezed right through that. But anyway, I think people are expecting or beginning to sense that banks, or that the U.S. will get downgraded again, perhaps as soon as December, and then you're going to get another run of short covering, which may have begun this week. God, and again, I'm sorry, I talked for 5 minutes. I have no idea what the original question was, and I'm not even drinking. I just must be getting old. So anyway, I hope that answered your question. Whatever it was, I hope that answered your question.
Well, basically, we're just discussing the attainability of silver and of physical silver, and how what do you think that as far as the demand and the concept of in the real world finding actual silver, and in fiat terms or any other valuation that you think is more appropriate to value?
I remember the question now, and yes, I mean the evidence is there that there are shortages, and now I remember how I got off on that tangent, because we were talking about this buying that now develops when the price dips, and that I don't see that trend changing, and that will continue to press on physical demand. So the shortages you see now and the anecdotal evidence we have of it now will only continue, and that's, I mean, so anyway, I believe it. I think that there are shortages.
So and what I've heard is there's actually some discrepancy on what you have to spend to get it, in comparison with the spot prices. There's actually started to be a digression.
Yeah, and that gets back to the physical exchange in China. That the premiums now are getting so high is what is really, the premium that you pay for that physical. It's like going on to APMEX or Provident Metals or something, and silver's trading at $35 an ounce, but they want $39 per eagle, or per maple. Or if you go on eBay and try to buy it, they try to tell you, the futures market's trying to tell you it's at $35, but this guy on eBay wants $45. So what really is the price? And so that's that futures tail wagging the spot dog. In fact, Ned's metaphor is he takes it one further. He's got the bullion banks, the JP Morgan and HSBC and the like. They're the hand that holds the tail, that shakes the tail, which then causes the spot dog to shake. Works pretty well for them, but that demand, that's one of the key components to breaking that chain, no doubt about it. And it certainly looks like it's there, and it's going to continue to be there.
And you think it's going to continue to make a larger difference between what they call the spot price and the actual price?
Absolutely. No question about it. At least that's what I'm trying to do. I mean, that's what we're all of this whole group of us, I guess, whoever we are, in the blogosphere, trying to alert folks. The more people that, day by day, that are awakened to this and realize that the only real financial insurance, the only currency that does not have a counterparty risk, is gold and silver. And that demand is only going to continue to increase. I mean, what would change it at this point? Why would all of a sudden, oh no, everything's fine? I don't see that happening.
Well, based on history and common sense, I mean, I have to agree with you.
Yeah.
Thanks.
Sure.
Okay, for our next question, we're going to turn to Dr. Steve.
Dr. Steve.
Hey, Turd. Good evening. How are you?
Fine, thank you, Dr. Steve. How are you today?
Excellent. Listening and talking to you, it's wonderful. It's an honor.
Oh, gosh. Thank you.
You're blushing.
Yes. Yes.
Anyway, this question is from a WebBot member preferred it. It's on brokerages and mining. And the question is, it's regarding contraparty risks compared to the intrinsic advantages of owning physical precious metal bullion. It's my understanding that most brokerages register their clients' investments under their own street name instead of under the client's name. Is this true? And if so, what happens if a tsunami of brokerages simultaneously become insolvent? What is the actual role, for example, of the SIPC, and what is their capacity to effectively deal with mass brokerage insolvency?
I don't think they. I don't think they have a capacity to deal with it. It's like I just compare it to the FDIC, which is essentially the same thing. You know, banks paying the FDIC, Federal Deposit Insurance Corporation, to to give this semblance of safety and guarantees to your bank deposits. The securities. What is it? Securities Investment Protection Corp or Securities Investor Protection Corp is the same thing for broker dealers, and they pay a premium to fund it. FDIC is all well and good when there's only 3 banks every Friday that go broke. You know, they get bought by somebody else with some FDIC help, and then they reopen on Monday, and everybody's well and good. One brokerage firm goes out of business at a time that can make the SIPC work. If they all collapse at once, well, getting your hand on your stock certificate is probably the last of your worries at that point. Nonetheless, anyone that holds their securities or their metal in what is, I guess, commonly known as street name is allowing their brokerage firm to loan that stuff out. Like if you own 100 shares of Apple, and you hold it in street name in your Merrill Lynch account, and another Merrill Lynch client wants to sell Apple short, they have to borrow those shares and to sell them, because that short seller doesn't have it. So they're going to borrow those shares from you, even though you don't know it, and sell them to another buyer, thereby creating that short position. And you still have your Apple shares. It's along on your statement, and if they'd come up with it if you had to ask for a statement, but nonetheless, it's all commingled. If you don't like that, if you don't want that, if you're worried about your brokerage firm going belly up and you have to get in line waiting for your stock certificates, I'd encourage you to take your stock certificates now. I mean, go the old lady route. I mean, that's what, back when I was a stockbroker 20 years ago, that's what all the gambling old ladies did. Just go ahead and send me my certificates, Sonny. And so you would, and they'd put them in the safe deposit box. Probably not a bad idea these days. In terms of metal, same game gets played. If you have what is called unallocated gold, and that's gold that's stored in a vault owned by a bullion bank, that bank can lease it, can utilize it in their own short selling, anything. That's the whole fractional bullion banking system, is that there are multiple claims on the same ounce of gold. The gold that you have in your safe, the gold that you own in your own 2 hands, is allocated. Okay. How do you know you own 100 shares of Apple? Well, because you've got a certificate that says, owned by you, or joint tenancy with your spouse or whatever, and you own it. That's it. To a different extent, how do you know you own gold? Well, the only way you know you own it is if you have it in your hands. You hold it. Period. So I would encourage, there are several kind of alternative vault companies that are out there, where it is fully allocated gold, and you can go look and see it and touch it and all that stuff. That's where I'd have mine if I didn't have it buried in the backyard. I didn't say that. It's not really in my back. Don't come to my house and start digging in my backyard. It's not in my backyard.
Where do you live?
Yeah, exactly. I live right next door to Fox. It's in his backyard.
Okay, next question. Thank you for answering the first question. Second question. This question focuses on contra-party risks associated with purchasing mining stocks. Gold and silver miners have been touted as a top-tier of stock ownership when valued at their proven resources and historical management capacity to produce above ground bullion. Many of these miners are predicting significant increases of bullion output at the same time that the actual valuations of the bullion they produce is expected by many to geometrically increase in value. To further sweeten the pot, these miners are currently significantly undervalued with respect to the current upswing in precious metals valuations. Issues like nationalization and luxury taxes are definite concerns of the investing community. Please discuss your take on the risk/reward fundamentals of miners and stocks, including sovereign confiscation and super taxes in your analysis.
Boy, oh boy, that's another one of these long questions. I'll try to give that as short of an answer as I can. Yes, all of those the geopolitical risks, and which leads to this kind of nationalization risk, and then you got taxation you got to worry about, which kind of almost even dovetails into confiscation. Those are all things that we can all speculate upon, and you've got to be wary of, even on an individual basis. Who was it? Agnico Eagle Mines just had one of their main mines get flooded. A week ago? Stock went down 20%. You got to be wary of these kind of things. I would rather, the part that I would, I guess, prefer to spend time answering is the valuation part, because mining stocks drive people crazy, and rightfully so, because they don't seem to reflect the value. Many of them are trading at the same share price that they were 7-8 years ago when gold was $400 or $500 an ounce, and so it doesn't make any sense. And there are a number of factors that cause the individual issues or the sector in general to not display its true value. I don't know. Maybe I'll just stop there. You want me to kind of rattle them all off, or pick one, my favorite one?
Pick your favorite one, of course.
Okay. Let's get back to the brokerage firms that we talked about earlier and how they might give you a research report. Remember how equity, the analysis of equities works. You have some guy or gal that's a CFA, and they go out and they meet the company and they decide that there's earnings estimates. And yes, we think that company X is going to make $2 a share this year. And then the people look at that and say, well, within this industry, that should have a historic price earnings ratio of about 20. So therefore our price target this year is 40, right? That's about how that works. In a mining stock, there's an extra little wrinkle, and that is you can't project earnings without projecting the price of that commodity. Okay, so the analyst will go out and say, hey, we love this company, they're doing great, they're controlling their costs, their energy costs, their input costs, all this jazz. But the thing that equity analyst doesn't control is the year end, this year, next year price of where they think gold or silver is going to be, where that commodity analyst of the same firm thinks gold and silver are going to be. So the equity analyst might love Gold Corp and want to say they're going to earn a certain level of shares, and the equity analyst may have their own personal opinion where they think gold is going. But the equity analyst firm will only allow him or her to use in their calculations of earnings the number that the commodity analyst of the firm says gold's going to trade at. So now you get into the politics of the whole thing, because if the firm is, say, JP Morgan, and they have a vested interest in not seeing silver trade at $60 or $80 an ounce, well, I don't know what the JP Morgan analyst, actually the JP Morgan gold guy just came out with a $2,500 price target. But silver, I don't know what they're, but anyway, you can see where there's kind of a conflict of interest there. So the Merrill Lynch gold analyst may say, we think gold is going to be $1,300 in 2011 and $1,400 in 2012. And believe it or not, those numbers are out there. Well, the equity analyst that follows Gold Corp or come up with their earnings projections, they have to use that $1,300 or $1,400 number, regardless of where gold is today. They have to use those numbers. So therefore, then all of a sudden you get an earnings projection of only $1 a share and a share price of 20, and they go, oh, see, $20 is a good share price. So that is just one of the factors that causes gold miners to not currently reflect the true value of what their future earnings are going to be. And it's just one of the things that drives mining share investors crazy. It's like any other kind of speculative investment. Your best bet maybe is to buy a handful of them, take delivery of the certificates, stick them in your desk drawer, your safe, and then come back and look in a couple of years and see what they're worth, because on a day-to-day basis, they're going to drive you bats.
Okay. I have a question for you regarding your website. Do you have any plans to sell Turd Ferguson 1 ounce silver rounds with a big hat on one side and a pile of turd on the other?
I would love to. Wouldn't that be fun? If we can make money off of it. No. I have a friend that actually knows a guy that's a jeweler that thinks he can make some. It would be a hoot. I'm not sure if I'd make it a coin. We might have to make it something more naturally correct. You know, that might be kind of fun. But yeah, that'd be fun, wouldn't it?
Yeah, I think people would love to add to their physical piles.
I'll tell you a funny story, though. A guy, this was not long after I started the thing a year ago. Guy donates money, hits the feed the turd button, and sends me $10. And I send him a thank you note, because I always send everybody a thank you note. Everybody that ever gives me money, I'm so stunned and appreciative that somebody would actually do that. I just started at the beginning, always sending a thank you note. So I sent it, not a handwritten, an email. So I sent this guy an email. He sends me a thing back. He says, well, I thought it was the least I could do. He said, I've had this dog crap old coin on eBay forever. And I had it listed for $20. And the biggest bid I ever got for was like $1. And he said, nobody ever bought it. He said, I went in and renamed it a Turd Dollar. And somebody bought it for $20. He said, so least I could do is send you half of it. So he sent me $10. So I don't know. Maybe there really is a market for some turdency. We'll see.
Dr. Steve, thanks very much for hitting Turd up with a couple of hard questions and finishing it up with a softball. We all love a lobbed ball question when it comes to us. And for our last lobbed softball question, we're going to hand you over to Romans.
Hi, Turd. This is Romans back at you. I'm going to ask you to put on your great Karnak hat here and look into your crystal ball and see what you have to think about this. To me, it seems like all the leverage markets are on borrowed time. Turd, I wanted to ask you to put on your great Karnak hat again and look into your crystal ball and see what you have to think about this. To me, it seems like the leverage investment markets are on borrowed time. Whether or not you agree, do you think it would be days or weeks or years? Do you think they'll always be around, or do you think they are on borrowed time?
Yes. How's that? This will continue. They will continue to be on borrowed time a lot longer than I think probably any of us would expect. The old adage is don't go around betting on the end of the world because it's only going to happen once.
Right.
And there's obviously truth to that. We have been what seems like to the precipice. God, how many times in the last 3 years? In the last 3 months. I mean, there was that weekend 6-8 weeks ago when Italy was going to implode over the weekend, and this time on a Friday night, nobody had any idea what was going to happen Monday.
Right.
We just went through it again really this week. do not be surprised by the ability of those in power to maintain their power for as long as possible. So do I expect something? Let's put it this way. I don't expect something within days or weeks. Could something happen? Of course. I mean, there could be it's so many different. I mean, the analogy or the again, I get my analogies and metaphors messed up. I make fun of this all the time. It's one or the other, but the house of cards, it gets overused, but it is. It's or it's a Jenga game. You ever play Jenga?
Yes.
You know, where you stack. We're just stacking at this
Right.
point. We're taking out of the base and putting it on the top, and it's fun, and it goes on for a while, and then finally, it's one piece too many, and when that piece is going to get stacked, I would think it's not going to be a whole lot longer, just because of the negative impacts of leverage and compounding interest. But again, I don't think anybody should be surprised at the ability of the powers that be to hold on to their power. Will probably drag things on for a while still.
Yeah, I think these credit default swaps, all it's going to take is the first guy to go, and then it's going to be like dominoes, I think.
Yeah, it's like the thing, and this is still, and here I try not to get myself all worked up, but the thing with Bank of America taking the $53 trillion in Merrill Lynch credit default swaps and sticking it into their regular Bank of America NA unit, to give the counterparties to those swaps the feeling that there are at least some assets behind them should they need them. I mean, it's really almost criminal. I mean, you want something to be upset about. You know, the 99%, you want to be really ticked off about something. Right there, there's a transference of $53 trillion of negligence right onto the back of the taxpayer.
Right.
And it's disgusting that they're able to do it. But okay, so now you've got $53 trillion in credit default swap derivatives. The Bank of America has $1 trillion in customer deposits. I don't know what their total asset base would be, but it'll only take 2% of those credit default swaps to come get swapped. And there's your trillion. So the game is being played to just kind of extend and pretend and kick the can farther down but eventually, I mean, when that happens, I'm not sure. And hopefully it's a while still, so that as we try to prepare for the end of the Great Keynesian experiment, we have as much time as possible. I hope it's not Tuesday, but it could be. Who knows?
Right. As long as it goes on, at least we have a little more time to keep stacking.
That's right. Keep on stacking. You're never going to go wrong.
Well, thank you very much for answering my questions. I'm going to flip it back over to McLaren.
Okay, thanks very much. Third, we're talking about deflation now. When we've got debt going bad, as the 100 to 1, 400 to 1 leverage in the paper metals markets theoretically gets blown out. You're looking at all kinds of potentially deflationary scenarios currently playing out in Europe, with 50% haircuts on Greek debt, and theoretically the other members of the PIGS, Portugal, Ireland, Italy, also wanting to get similar haircuts. How low do you see leverage going? Can it go? How low can it go? All the way back down to, you're talking about, give me a gold coin or get out of my face.
It could, yeah. It certainly could. Will it is another story. And I don't know if this is incongruent thinking, but I'm a firm believer that deflation or disinflation can occur in the world at the same time as inflation. And it is that inflation. I don't think it's the deflation that's going to be a problem. I mean, frankly, what's wrong with that to some extent? If the money that you have can buy you more of something tomorrow, that's for a lot of things, that's a good thing. If I manage to save $100,000 and a house that was 150 is now worth 100, so I can buy it, hey, great. That's. Go ahead. I'm sorry.
I agree. I mean, I would love to be able to go buy an acre of unimproved raw land for 1 ounce of gold. I mean, at one time, that's kind of where it was. Mm-hmm. You get an acre of improved land, meaning trees have been cleared and it's in a meadow condition for 2 ounces of gold. 3 ounces of gold gets you that meadow that also has irrigation laid in it. Mm-hmm. And then you're talking about, I don't know, 1,000 ounces of silver for a house or something.
Yeah, or a suit, or that's not a bad thing. And again, this is just me and my some minimally economic trained brain talking. But the real issue then, though, is to mitigate the effects of this deflation. You've got the Fed printing money, and all you have to do is look at the price of gold since March of 2000. Well, really going back to 2002, but specifically to March 2009, you can see the price trend. If you look at the either an index of commodities or look at the individual commodities themselves. Heck, we were keeping a running total on the blog and on the site back during the quantitative easing number 2 of the month-over-month changes of corn and wheat and crude oil and all these dollar-denominated assets. And if you're going to have more and more dollars chasing a static or, in the event of crop failure or something like that, or just global demand, a declining amount of goods, the price is going to go up. And if you're sufficiently wealthy or protected enough that you can deal with that, good for you. And that's what we're trying to help people and teach people to think about at the TF Metals Report site. But if you're part of the 22.6%, and then really a bigger group than that is just living above the poverty level or is just simply trying to eke by on 2 incomes, and a mortgage, and all of a sudden you can't hardly even drive to work because gas is $5 a gallon, and you can't afford to feed your kids because cobbling together a dinner with hamburger at $5 a pound and that kind of thing. I mean, that's a serious deal. And then I'm talking everyday American life because that's my experience. But, what if you are trying to feed 1.2 billion Chinese and the price of rice is going through the roof? Well, that's a recipe for some geopolitical instability. And these are all things that this reckless printing of money trying to paper over the problem is leading to. And it's going to be a very interesting rest of this year in 2012. That you can be assured.
Yeah, interesting times to come. We've been speaking with Turd Ferguson of tfmetalsreport.com. Thank you for sharing your time and thoughts with us again, Turd. We hope that the listeners have gained insights into the topics we've been discussing, and we hope that you enjoyed it as much as we did. If you didn't, look in that Keynesian rearview mirror for those hours and minutes. They're not out the front windscreen. On behalf of Fox and all of the members of the WebBot Forum, thank you, Turd. And in our tradition, may you and yours have many tasty pies to come.
Thank you very much. It's been my pleasure.
Todd
Thank you.
from RT.
No.
Thank you, Turd from RTG. Thank you.
Oh, it's such an honor. Thank you. I really.
Thank you. You have a great website.
Oh, I'm glad you feel that way. It's still kind of a work in progress, but the real value there is not the information that you can get from me. It's clicking around and reading the comments and going into the forums, because that's why I built it. I mean, I knew that what I have to add is limited, but if I could leverage everybody else, then we'd really have something. And so I encourage everybody to really go in there and sniff around, because there's all kinds of good stuff there.